Good morning, ladies and gentlemen. Welcome to Business Law. Today we are going to start by looking at LO1, which is the nature of a company. Now, there are types of business organizations that we are going to discuss, namely a service business, merchandising, manufacturing business, and hybrid businesses. Now, in the very first place, what is a business? Now, a business is an organization that uses economic resources or inputs to provide goods or services to customers in exchange for money or other goods and services. Now, a business organization, it can come in different forms, which we want to talk about, namely service business, merchandising business, manufacturing business, and hybrid business. Now, a service business is a type of a business which provides intangible products. These are products with no physical form. So service type firms offer professional skills, expertise, advice, and other similar products. Examples of these service businesses are schools where you are taught the product is intangible, repair shops, hair salons, banks, accounting firms, and law firms. Because when you leave that business, you do not leave holding something, but you would have received some form of service. Now, the second type of business would be the merchandising business. Now, this type of business buys products at wholesale prices and sells the same at retail price. They are known as buy and sell businesses. Okay? They make profit by selling the products at prices higher than their purchase costs. So a merchandising business sells a product without changing its form. Examples would be like grocery stores, convenience stores, distributors, and other resellers. So that is what typically happens when you go to the shops. You go, you buy your groceries. They've been imported, and then the shop puts a markup and then they sell to you. So that is a merchandising business. Now, let's look at a manufacturing business. Now, unlike a merchandising business, a manufacturing business, these ones, they buy products with the intention of using them as raw materials in making a new product. There is a transformation of the products purchased. Now, in a manufacturing business, they combine raw materials, labor, and factory overhead in their production process. And then the manufactured goods will then be sold to customers. So it's like, if it's, for example, a forester will cut down trees and then make timber. That same timber will be then used to make tables. So that is like the manufacturing business. And then let's talk about the hybrid business. Now, a hybrid business, these are companies that are classified in more than one type of a business. Like a restaurant, for example. They combine ingredients to make a fine meal, which we would call manufacturing. And then they sell a cold bottle of wine, which they bought and then put a markup. So that is merchandising. And then they fill customer orders, which we would call a service. Nonetheless, these companies may be classified according to their major business interest. In that case, restaurants are more of the service type because they provide dining services. Now, let's talk of forms of business organizations. Now, we have three basic forms of business organizations. We have the sole proprietorship, we have partnership, and then we have a company. So we are going to look at these and a few others as we go along. Now, a sole proprietorship. Now, this is a type of a business unit where one person is solely responsible for providing the capital and bearing the risk of the enterprise for the management of the business. So it's more of saying one person owns this business, he runs it according to whichever way he finds fit. Now, a sole proprietorship, it's a business owned by only one person. It's easy to set up and is the least costly among all forms of ownership. The owner faces unlimited liability, meaning the creditors of the business may go after the personal assets of the owner if the business cannot pay them. The sole proprietorship form is usually adopted by small business entities, and there are a number of characteristics of sole proprietorship business organization. Now, the first one is that single ownership. Normally, a sole trader, it would be one person who owns a single owner, who starts the business using his own resources, and then there is no separation of ownership and management. That is another characteristic of a sole proprietorship, meaning that the owner himself manages the business as per his or her own skill and intelligence. There is no separation of ownership and management, as is the case with company form of business organization. So a sole proprietor contributes and organizes the resources in a systematic way and controls the activities with the objective of earning a profit. The other characteristic is that there is less legal formalities. Now, the formation and operation of a sole proprietorship form of business organization, it does not involve any legal formalities. Thus, its formation is quite easy and simple. Another characteristic is that it has no separate entity. Now, the business unit does not have an entity separate from the owner. This is what it means. The businessman and the business enterprise are one and the same, and the businessman is responsible for everything that happens in his business unit. So he is personally liable. You will also find that there is no sharing of profits and loss, because the sole proprietor enjoys the profits alone. At the same time, the entire loss is also borne by him. No other person is there to share the profits and losses of the business, and he alone bears the risks and reaps the profits. And then the other major thing is that there is unlimited liability. Now, the liability of the sole proprietor is unlimited. In case of loss, if his business assets are not enough to pay the business liabilities, his personal property can also be utilized to pay off the liabilities of the business. However, there are a number of advantages of being a sole trader. It's easy to form. You're a single person, you raise whichever capital you can raise, and then you quickly start the business. You can make quick decisions as you go to suit the market environment, therefore making it flexible in operation. And you don't have to give out company secrets, or you keep your secrets or operational maintenance of business secrets by yourself, and you are able to personalize it and give it your personal touch. However, there are some limitations of or disadvantages of sole proprietorship. Seeing that it's a single individual who comes in to start the business, he might have limited resources. And it is not easy to get other resources in terms of bank loans and people to help you financially or with other resources. And then we find that there is lack of continuity, because if he dies, the business also dies. And then again, of course, there is limited liability, because the businessman and the business, they are one and the same person. And also that it is not suitable for large-scale operations. And since he makes all the decisions, you find that in a sole proprietorship, there is a limited managerial expertise, which does affect the growth of the business. Let's talk about a partnership. Now, a partnership is a business owned by two or more people who contribute resources into the entity. Now, the partners, they divide the profits of the business amongst themselves. So, in general, partnerships have unlimited liability. However, in limited partnerships, creditors cannot go after the personal assets of the limited partners. Now, let's talk about the characteristics of a partnership form of business organization. Number one, the main thing is that two or more persons. Now, to form a partnership or to have a partnership firm, at least two people are required. The maximum limit on the number of persons is 10 for banking business and 20 for other businesses. If the number exceeds the above limit, the partnership becomes illegal and the relationship among them cannot be called a partnership. The other thing is the contractual relationship. Now, a partnership is created by an agreement among the persons who have agreed to join hands. Such persons must be competent to contract. That is, minors, lunatics, and insolvent persons are not eligible to become partners. However, a minor can be admitted to the benefits of partnership firm, that is, if he can have a share in the profits without any obligation for losses. So you'll find that with the partnership, there's also flexibility, sharing of risks, which makes it a better form than a sole leadership. Now, there are different types of partners. So you'd find that there are active, what we call active partners. The partners who actively participate in day-to-day operations of the business are known as active partners or working partners. Then those partners who do not participate in day-to-day activities of the business are known as sleeping or dormant partners. Such partners simply contribute capital and share the profits and losses of the partnership. And then we have nominal partners and partners in profits. Now, nominal partners allow the firm to use their name as partner. They neither invest any capital or participate in the day-to-day operations of the business. They are not entitled to share the profits of the firm. Okay. However, they are liable to third parties for all the acts of the firm. So a person who shares the profits of the business without being liable for the losses is known as partner in profits. And this is applicable only to the minors who are admitted to the benefits of the firm, and their liability is limited to their capital contribution. Okay. Now, based on liability, partners can also be classified as limited partners and general partners. Now, the liability of limited partners is limited to the extent of their capital contribution. This type of partner is found in limited partnership firms in some European countries and in the United States of America. However, so far it's not allowed in other countries such as in India. Now, the partners having unlimited liability are called as general partners or partners with unlimited liability. And also it can be noted that every partner who is not a limited partner is treated as a general partner. And then lastly, we want to talk about partners by estoppel, partners by holding out. Let me explain it this way. So a person who behaves in public in such a way to give an impression that he or she is a partner of the firm is called partner by estoppel. Such partners are not entitled to the share of the profits of the firm, but are fully liable if somebody suffers because of his or her false representation. Again, if a partner or partnership firm declares that a particular person is a partner of their firm, and such a person does not disclaim it, then he or she is known as partner by holding out. Such partners are not entitled to profits but are fully liable as regards the firm's debts. Okay, so that's it on types of partners. Let's talk about a corporation. Now, a corporation is a business organization that has a separate legal personality from its owners. So you find that ownership in stock corporation is represented by shares of stock, and the owners or the stockholders, they enjoy limited liability but have limited involvement in the company's operations. So that is the board of directors, an elected group from the stockholders, control the activities of the corporation. Now, let's talk about a limited liability company. Now, limited liability companies, these are hybrid forms of business that have characteristics of both a corporation and a partnership. Now, a limited liability company is not incorporated, hence it is not considered a cooperation. However, the owners enjoy limited liability like in a corporation. And a limited liability corporation may elect to be taxed as a sole proprietorship, a partnership, or a cooperation. Now, you'll find that a limited liability company, it has a memorandum of association which describes what company has been formed to do, which are the articles of association, covering things like what directors can do, the voting rights of shareholders, and so on. And then let's talk about cooperative. Now, a cooperative society is defined as a society which has its objectives for the promotion of economic interests of its members in accordance with cooperative principles. So therefore, a cooperative is a business organization owned by a group of individuals, and it's operated for their mutual benefit. So you find that the people making up the group, these are called members of the cooperative. And a cooperative, it can be incorporated or it can be unincorporated. Okay. Now, before we get to the limitations of a cooperative, I'd like to state a few characteristics of a cooperative society. Now, you'll find that a cooperative, it is voluntary association. What I mean by that is that members join the cooperative society voluntarily. That is by their own choice. So you find that persons having common economic objective can join the society as and when they like, continue as they like, and leave the society as and when they want. The other thing is that it is open membership, is in that the membership is open to all those having a common economic interest, and any person can become a member irrespective of his or her state, creed, religion, color, sex, etc. Okay. Now, if we're looking at the number of members, a minimum of 10 members are required to form a cooperative society. However, in state of multi-state cooperative societies, the minimum number of members should be 50 from each state in case the members are individuals. Then registration of the society in Botswana. Cooperative societies are registered under the Cooperative Societies Act 1801. And then the members, they get a return on their capital investment in the form of a dividend. Now, after giving a limited dividend to the members of the society, the surplus profit is distributed in the form of bonus, keeping aside a certain percentage as reserve and for general welfare of the society. Now you'll find that cooperatives, they are very easy to form. They've limited liability, they've open membership, they do get state assistance, and they do maintain a stable life. However, they have limited capital and lack of managerial expertise, and there's less motivation, seeing that you find that there are only a few dominant participants, and then the rest are just laid back, sitting, expecting others to work. And sometimes you can find that there is a lack of interest and a heavy dependence on government intervention. Now, let's talk about the different types of companies. Now, a company is an artificial person which arises when a group of persons form a corporate body which can acquire personality separate from that of its members, with some legal powers of a natural person. For example, a company can sue or it can be sued. It can own property and make contracts even in its own members, in its own name, so to speak. So we do have a company limited by shares. This can be a private company, public company. We have company limited by guarantee. We have closed company and external company and the foreign company. Let's talk about incorporation. Now, incorporation, this is where you take your small business or your partnership and then you turn it into a company. Are we together? Now, prospective entrepreneurs and established business people operating sole proprietorships and partnership, they are encouraged to weigh several factors when considering incorporating. Now, there are a couple of disadvantages of incorporation. You see, as a sole trader, you need there's less legal work, quick decision making and so forth. But then once you incorporate your business, you're going to incur legal expenses and lots of formalities to get the business running. And then you would need to give corporate disclosure. You can't keep so much of the secrets to yourself. And then the business now has a separate ownership between the owner and itself. And then again, once incorporated, we need to abide by the laws, not just as in the greater society will have an interest in what you are doing once incorporated, and this does affect how you operate. And sometimes you can find that there's greater tax burden in some cases, and you can't just close down. There's a lot involved in winding up the company if at the end of the business the company has to wind down. However, it has its own advantages. You'll find that there is limited liability, right? So an incorporated company, it's a legally recognized entity that exists separately from its owners and shareholders, which is different from partnership companies. Now, the Companies Act, it provides that in an event of a company being shut down, the members of the company are solely liable to contribute to the assets and liabilities of the company. However, in the case of companies that have been incorporated, none of the members is legally bound to contribute to anything more than the nominal value of shares held by the member, which still remain unpaid. So the advantage of having limited liability for its member is one of the major reasons for setting up incorporated company. And the other advantage is perpetual succession. What we mean by this is that in spite of any changes in members of the company will be the same entity with the same privileges, immunities, estate, and possessions. The death or insolvency of individual members does not affect the incorporated company in any way. The company will continue to exist indefinitely till the company is shut down. So as the Company Act states, members may come and members may go, but the company can go on forever. The other advantage of incorporation is transferable shares. The shares of any member in a company are treated as movable property. They are transferable in the manner provided by the articles of the company. This leads to the investment of funds in shares. It is done so that members can encash shares at any given time upon their will. It also serves the purpose of providing liquidity to the investors. They can sell shares anytime they are willing to on the open market or on the stock exchange. Let's look at the concept of legality. Now, legality can be defined as an act, agreement, or contract that is consistent with the law or state of being lawful or unlawful in a given jurisdiction. So here we have 4 types of law that we have in our legislative system. So we have criminal law, civil law, common law, and statutory law. Now, let's look at companies versus partnerships. We want to look at the key differences between a partnership firm and a company. Now, a partnership, it's an agreement between 2 or more persons who come together to carry out a business and share profit and losses mutually, right? Whereas a company is an incorporated association, also called an artificial person, having a separate identity, common sale, and perpetual succession. The other thing is that the registration of the partnership firm is not compulsory, whereas to form a company, it needs to be registered. Okay. Now, the other thing is that for the creation of a partnership, there must be at least 2 partners. Whereas for a formation of a company, there must be at least 2 members in case of private companies and 7 in regard to public companies. And then the limit for the maximum number of partners in a partnership firm is 25. Whereas on the other hand, the maximum number of partners in case of a public company is unlimited. In the case of a private company, that limit is 200. And then the next major difference between them is there is no minimum capital requirement for starting a partnership firm. Whereas the minimum capital required for a public company is 5 lakhs. In the event of dissolution of the partnership firm, there are no legal formalities, whereas a company has many legal formalities for winding up. Now, finally, we would also want to look at similarities between a partnership and a company. Now, partnerships and limited liability companies, they present several similarities. for business owners looking for the right company structure. Now, both of them have similar income distribution and tax reporting formats, and both are simpler to set up and operate than a corporation. Now, all owners may have unlimited personal liability with a partnership, but establishing a business as a limited partnership leaves most owners insulated from such risks. Within a limited partnership structure, only one general partner assumes unlimited liability. All inactive limited partners have limited liability just as they do with a company. Now, the income distribution and tax reporting for owners are similar with partnerships and companies. In both setups, profit normally is shared evenly among the owners unless agreed upon differently in writing. For certain partnership, partners may agree to invest different amounts of resources and therefore profit unequal. So this is it, ladies and gentlemen, on LO1. Let's meet in the next lesson. Thank you for joining me in LO1 Nature of a Company.